On the other hand, interest expense is cash, but it is not an operating expense. Your operating expenses in this case are just cost of goods sold. I mean, if I also gave you other stuff uh, like selling, general, administrative, and that sort of stuff, those also would be operating expenses.
So is that why?
That's why we're adding them back. Okay. Again, I'm not. There are two ways you can calculate operating cash flow. One is the simple way that I keep using. To net income, you add interest expense plus depreciation, or you can calculate EBIT, okay, which is earnings before interest and taxes, but that also includes depreciation. And then you deduct interest expense from that, then taxes, that gives you net income, then you add back. Or there's something called using tax shield. Don't even go into that.
So what is the way that you do it? Like, what's the more simple way?
Net income plus depreciation plus interest expense. That's it. Done. Yeah. Remember, the reason I calculate net income first, both, even though they are not operating expenses per se, both depreciation and interest expense reduce your taxes. So they are not irrelevant to your operations. It's still relevant. Or they're not irrelevant to your cash. If I have a lot of interest expense, it reduces my taxes, but it is not an operating cost. So that's why I calculate my net income first, take advantage of those tax shields these things generate. But for operating purposes, I'm going to have to add back both depreciation and what you want to call uh, interest expense. Another way to think about it, you start with your EBITDA, which is earnings before interest, taxes, and depreciation and amortizations. And you you deduct after, you add back after tax depreciation and interest expense. But that's what we're doing when we do net income plus depreciation plus interest expense. I mean, there are a lot of ways to skin that sheep, but I like my way a lot better because it's simpler. Remember, if something is simpler to do, you should always pick that because you're less likely to make a mistake. Because if you've done anything well, if you're, I mean, you should be knowing how to calculate net income anyway, right? If you can't calculate net income, there's no way you'll be able to answer this question anyway, independent of how you're going to calculate your operating cash flow. So calculate your net income, add back depreciation and interest expense. So let's see, in this case, 745 minus 590, 800. That's my EBITDA. Minus depreciation, 82,600. That's my EBIT, earnings before interest and taxes. Minus the interest expense, 15,500. That's my EBT, earnings before taxes. Times 1 minus the tax rate, 0.65. That's my net income. Plus depreciation, plus interest expense. So it's 134,630. Again, I don't particularly care whether the answer you gave was correct. You kind of approached it the right way. It's a little bit roundabout, but didn't miss anything crucial. Again, I would rate that a 5 as well. All right. In the remaining part, let me briefly go about Microsoft's let me make this a bit bigger. All right. Now, as you have heard in the lectures, if you actually watch the videos, there is a logic to how we organize financial statements. In the balance sheet on the asset side, The assets are things you own. Okay, we order them from the most liquid to least liquid. When we say liquid or liquidity, liquidity is the speed with which you can convert an asset into cash without losing too much in value. I can convert anything into cash in 5 seconds, if as long as I'm willing to get a big haircut. You give me a Boeing 787, I can sell that in 10 seconds on Craigslist. Damn thing is worth 100 million. If I put it up for 10 million, it'll go. Okay. But that doesn't mean that's a liquid asset. On the other hand, cash, most liquid, uh, cash, we're not talking about just cash in your pocket. It's also the so-called demand deposits in the banks. A lot of times, especially these days, we consider short-term investments as almost cash. So in this case, Microsoft has about $75 billion in almost cash. That's an important number. Okay. In fact, they put them together as well. Accounts receivable are also considered liquid, but not as liquid as cash. Why? Because accounts receivables are what your customers owe you. Typically, anywhere from 30 to 90 days. You tell them, okay, I'm selling you my product, but you pay me in 30 days. That's an accounts receivable. And you don't charge any interest on that. If technically there is interest, you charge them a little bit higher price if they do it on credit. But there is also a chance that these guys may not be able to pay you back. And you actually have net of allowance for doubtful receivables. Inventory typically is not as liquid. Why? You have to sell them. For Microsoft, that's pretty much a non-issue. They don't have much of an inventory, but Walmart would have a lot of inventory. I'll keep you guys 5 more minutes. Look at Walmart, 63 billion in inventories. Obviously, they have a lot of stuff on the shelves, and you know they need to wait to sell them. But they're also still considered liquid. You also have, in many cases, other current assets. Again, this is not an accounting class. We're not going to go into that. But if you prepaid for an order, you pay the cash, but you haven't received the services or the goods yet, that is considered a asset, current assets, because you're going to get it. Then we have the, let me go back to Microsoft. We have the fixed assets, things like plant, property, and equipment, land, real estate, machinery, and that sort of stuff. Uh, Generically speaking, we say something's the current assets if you could expect that to be converted into cash within a year or so. On the other hand, not all fixed assets are kind of equal. There are two types of fixed assets. One is called tangible. They have physical existence. This is a computer. It is a tangible asset. But we also have intangible assets. These do not have a physical existence. Copyrights, okay, patents, that sort of stuff. That doesn't mean they're not valuable. If you, I mean, you could buy the copyrights on something, or you're a pharmaceutical company, you actually bought a patent. Since you paid something for it, it's going to be listed as one of your assets. By the way, if you developed that drug yourself and got it patented in your books, it's going to stay as a zero because you haven't technically paid anything for that. The way we book fixed assets is historical cost of acquisition minus any depreciation and stuff like that. You guys may also see something like goodwill. This is it has nothing to do with will or that being good. It's not a social, touchy-feely kind of stuff. When a corporation makes an acquisition of another corporation or an asset, and it pays for that asset above its book value. The difference between the two is called goodwill. When Google bought YouTube back in 2004, I think, they paid $1.6 billion for that. What a cheap purchase that was. YouTube is responsible over 40% of Google's revenues right now. And Google is worth almost $3 trillion or $2 trillion. So YouTube should be worth a little bit less than 1 trillion. But they paid only $1.6 billion for that. But at the time, when you looked at YouTube's books, its net worth was only $500 million. So the difference between the two is called the goodwill. It comes because in accounting you have to do double entry bookkeeping, right? You paid 1.6 billion and you got something that's worth only $500 million in the books. Well, you have to balance that out, and you balance that out with the goodwill asset. In the old days, until 2006, goodwill was actually subject to amortization over 40 years. So that's, let's call it 1 billion. Every year you wrote off $25 million as amortization. Now you may have goodwill, but you subject it to asset impairment test. Is it still worth that much? And I'll give you this example and I'll send you guys home. Back around 2006 or 7, uh, before Facebook became Facebook, there was MySpace. You guys may have heard about it. These days, it's mostly the place that you don't want to be. All sorts of perverts are in MySpace. It's even worse than Craigslist. But Wall Street Journal paid about $500 million for MySpace. They figured social media is going to be big. Well, they were right on that. They just picked the wrong horse. And MySpace didn't even have any sales those days, and net worth wasn't much. So most of the $500 million was goodwill. Of course, a few years later, Facebook comes. Nobody goes to MySpace anymore. What Wall Street Journal had to do says, okay, this asset is not worth $500 million anymore. So it's impaired. You're going to write it off, which means you're going to write off that goodwill. And in the double entry bookkeeping, that's going to be a charge to your income statement as loss. Okay, that's how we do goodwill accounting these days. Go home. Remember, you have until Wednesday class time to do those quizzes, and we're going to play Jeopardy on chapter 2 on Wednesday. I'll let you know which groups are selected before you come to class. Again, I'm going to do it randomly. Me too.